Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Well, my American friends, I hope you enjoyed your Thanksgiving week. I saw friends, I saw family, I ate copious foods, I took naps, and now we are back to discuss the markets. Today, we will talk about bear market bottom formation. There are a few things that I'd like to discuss, a few data points we need to bring into this discussion. And hopefully what I'll leave you with today is an idea of the kinds of signals that show to us that we're near the bottom of the bear market. This is not a perfect science, but history is pretty clear on certain things we can look for. So we'll talk about all that today. If you enjoy my content, make sure to give this video a thumbs up and please subscribe to my channel. Your support will allow me to do this full time, and I cannot thank you enough. But we have much to discuss, so let's dig in, friends. As we sit here this morning looking around at the market, futures are a little bit red. They've been dipping since the open yesterday. At the same time, we're seeing lower yields in long-dated treasuries, which means they're catching a bid. And that suggests that bonds are kind of catching a safe haven bid here. When you think about all the FUD surrounding what's going on in China right now, they're having protests. Many people are expecting there to be some kind of a swift and harsh lockdown, as they are prone to do. And a lot of that is rattling the markets, creating fear, and out of that fear, we're seeing a traditional safe haven bid in long-dated treasuries. Not sure that this is a turning around of the trend of bonds this year, but I do think that when we get more to a place where the market is less concerned about inflation and more concerned about imminent recession and economic slowdown, which we're kind of in the middle of right now, but as we get more towards the imminent recession piece of this whole saga, I think we'll see treasuries catching more of a bid. They'll return to more of that traditional role. Not to mention the yields are considerably more attractive now. I mean, we've got casual people going on Treasury Direct for the first time ever. So things are changing around bonds after they've had this historic sell-off. An interesting thing to keep an eye on here this morning. Not much going on over here on Bitcoin. It's around 16,200. I do think at some point we will fall below these levels that we're at. If for no other reason, then we're kind of in no man's land. This is just an odd place on a high time frame to suddenly find support and the entire market to reverse. I think it's more likely, my base case being, that before the market's able to turn around for Bitcoin specifically, that it probably comes down and tests this level here somewhere around the 12,000, 11,500 mark. That's the high water close on multiple weeks in the middle of 2019, and it represents the next higher time frame area of friction. That's kind of what I have my sights set on for Bitcoin. But the most interesting place for the bear market has been the Dow Jones, even more than the S&P. The Dow Jones was the first of the major indices to fall below its 200-week average. You can see back here, it fell below that in September when the others were still fighting to get down there. And it has also provided the more stout retrace moves so far in this bear, whereas the S&P has been a little more muted in its movements and its oscillations up and down. The Dow Jones has been moving a lot bigger. What I've got on the screen, there's a lot of drawing on here. I was looking at the retracement levels for each of these bounces in the bear market, these pivots. What the Dow Jones has done is what is more traditional in a bear, which you see the retracement come up and reverse somewhere near the 70% retracement mark. Sometimes it stops in the 60s, sometimes it gets up to around 75, 78, near the 786 fib, but generally speaking, it's about 70%. It's kind of this hot zone here where my circle is. And the Dow Jones has been repeatedly finding this area as a place to turn around. It turned around at the 702 back here in February, at the 702 again in April, at the 618 here in August, and here we are coming back up once more to the 702. We've broken above the high from August. If we go back and look at the S&P, it hasn't quite done that. So it first rejected at the 618 earlier this year, and then on the second bounce made its way up just past the 702. But since then, neither of the subsequent moves have gotten very far at all. This one barely got above the halfway mark, didn't even touch the 618, and the current rally is considerably lower. It doesn't look at all like the Dow Jones, which is now above the August high. The S&P is still, what is that? About a 7 or 8% move away from getting back to that level. So it's been trailing behind, just like it trailed behind in breaking below its 200 week, unlike the Dow Jones, which did it a little earlier. So the Dow has been the place to watch for signal coming out of this bear market. And right now we're in a very tricky spot. More often than not, a rally stalls out in this range here, in this kind of sweet spot between the 618 and the 786. This is the area. We are smack dab in the middle of it. We have broken above the August high. Remember, this is when Jerome Powell came out here in August, where it was really down here somewhere. But he came out during this curl over of this inexplicable rally, and he told the market that they were wrong at the Jackson Hole Symposium when he gave an 8.5 minute long speech and basically told the market, we need to go lower. Some of you may recall we talked about this rally on the channel here and how the market had misinterpreted Fed comments from July, from around this time here, and had misinterpreted them bullishly and had sent itself inexplicably higher. Well, we have now seen that again. It's gone even beyond where it was in August, and this is a tricky spot. This is where we start to see sentiment turning around. The market is presenting itself as fully recovered. It is showing strength to the casual, low information investor. It's setting a higher high on the price chart. But the underlying economic situation that has led us from the all-time high to these lows this year, none of that has changed. And if anything, it will continue to deteriorate over the next few months because we've kind of set in motion some things that cannot simply be reversed. All of this Fed tightening since March, the drawdown of their balance sheet via QT, the repricing of all things led by the historic sell-off in the bond market, all of those have catalyzed a chain of events that we will see unfolding from now through next year. Monetary policy works on a lag. It's only been working so far for about 10 months. We've got considerably more time to go before we start digesting in full all of the actions taken by central banks this year. So the Dow Jones in a really tricky spot. Another thing really curious about this rally that we've been seeing is what's happened to the VIX. So just last night, we've seen the VIX, it's turned around a little bit this morning as we've seen equities selling off. But if I magnify this here, this low value on RSI, this is on a weekly chart for the VIX. This low value on RSI was the lowest RSI print since March of 2013 for the VIX. On a weekly time frame, it is the most oversold it has been in almost a decade. If we look at it on a 3-day chart, that low goes all the way back to 2012, back here, March of 2012. So another year beyond where the weekly chart is. So it goes without saying that high time frame on the VIX is extremely oversold. Volatility is heavily compressed here. And that, in combination with where we see the Dow Jones at its retraces, suggests to me we might be nearing the top of this rally. There's no way to really know that for sure. The market's going to do whatever it feels like. And with thin books and with news events catalyzing swift moves in intraday action, it's possible that we break a little bit higher. I don't know, but when I see all this confluence of technicals, it implies to me that maybe we're nearing the end of this. We're 20% off the lows. It's got to run out of steam at some point. And there are still things about this bear that are not like prior bear markets. There are things suggesting to us that we still have further to go, and beyond just where we are with the retrace. Beyond that, there are still aspects, technical aspects of this market that have not lined up with what a typical bear looks like, and they suggest that we haven't quite seen the end of the saga yet. So what am I talking about? Well, let's look at RSI. So what I've got up here is the S&P 500 in the last 6 major bear markets, and it's on a 3-day chart, and we're looking at RSI underneath it. Now, the major takeaway here is that in all prior bear markets, the S&P 500 has printed multiple days with a 3-day RSI below 30, down in the 20s. This has happened in every bear market capitulation for the S&P. However, in 2022, the S&P on a 3-day chart has yet to print an RSI below 31.2. We haven't even broken below 30, but you can see, and maybe these numbers are a little small on my screen here, but look where the gray box is. Every one of these bears before has printed below the gray box at least more than one candle, which on a 3-day chart is at least a week or more. Multiple market days spent below a 30 RSI on the 3-day chart. We haven't gotten below 31 and change in this year, which suggests that nothing we've really seen so far has been an actual dive in price action, a fall of the kind of capitulative sense that you would expect in a bear market. It suggests we haven't seen it yet. The same story is true for the Dow Jones. So I just explained how the S&P hasn't been the best indicator of this bear market. So maybe we should look to the Dow. Has it been performing any differently? No, it hasn't. That trend that I just described with the S&P is also true for the Dow Jones. In all prior bear markets, the Dow Jones has printed multiple 3-day RSI values below 30. We have not seen a 3-day RSI this year below 32. 2.7. So the Dow Jones is 2.5 points on the RSI above a capitulative level. The S&P is 1.5 or so above. Neither one of them have printed below a 30. Both of them suggesting to us that we have not seen an actual real sell-off in this market. And that perspective aligns with what we're seeing in the VIX, with the oversoldness of the VIX, with how little volatility is being registered by this instrument. I mean, we haven't even seen a VIX over this value here, 38.9. We have not seen a VIX in the 40s since COVID. That is something I expect will change before this bear market is over. I think we will see a significant volatility event. It will result in much lower 3-day RSI on the Dow Jones and the S&P, and it will probably see a blowout in the VIX. Over the weekend, I spent more time unpacking this current bear market and how it compares to bears over the last half a century. I went all the way back to the early 1960s on the S&P, and I compared all of the different percentage moves inside of the bear market. The up moves, the down moves, what the percentage was, how many days it took, etc. And I learned a couple of interesting things about the current bear market. Each bear market has its own color. You can see those down here at the bottom. The current market is in black. What you see at the bottom, we'll start at the bottom of this chart. These are the percentage drawdowns for the bear market. They're bucketed. So below a 10% drawdown from the all-time high, 10 to 20%, 20 to 30. This current bear market hasn't gotten below about 27, 28% from the all-time high. So all of the little black squares exist in the 10 to 20 and 20 to 30% box. We immediately fell 10% from the high, so there are no boxes printed here under 10%. When we compare this bear to other bears and the amount of time that the moves take and the percentages of those moves, it's rather conservative. So up at the top, I've got something called the up-down percent ratio, and this is called the up-down time ratio here. Now, these are comparisons of the moves upward in the bear market and the moves downward. So to give you an idea of what I mean by up and down moves, I literally counted the pivots. So like this is a pivot, and this is a pivot, and this is a pivot. And I went through the entire bear market, and I went through a bunch of them, and I counted these out. And I measured all of the different distances, I measured the percentages, and I wanted to do this to try to compare bear markets and see, is the movement of the current bear lining up with the kind of expectations we would have for what this market looks like. So this is the kind of way I counted this out, and I went all the way back to the early 1960s. And that's how I ended up with this distribution here. So what I'm looking at the top, this is the percentage of the move up to the move down. And if the value is over 1.0, that means that the up moves are bigger than the down moves. And you would expect in a bear market, the down moves would be bigger, and they typically are. But the interesting thing about this bear is that it distributes on the high end of this group, which means that for the most part, these oscillations in this bear have been relatively even. And you can see that in the price here, right? If we compare this to like 2008, for example. If we go back here and we look at 2008, look at this. It stayed even for a little while, right? Like there was a little bit of oscillation here, but then the bottom just fell out. And this created a huge unevenness to the downside. But here in today's bear market, this has been a relatively even slide. We haven't seen one of those big moves. Generally, the trend has been down, but it has been a lot more choppy. And so what that's ended up with is that we have rallies to the up and to the downside that are relatively even. Whereas most other bear markets, they skew lower. They skew towards the downside moves being longer in percentage. So I think we're still in the early stages of this bear. When I compare the time, now this is the number of days that transpire in an up move versus a down move. And again, this is skewing more evenly. It's almost right in the middle of the distribution, right at a 1.0, which is showing that the moves to the upside and the moves to the downside in terms of duration have been very comparable. Whereas in prior bear markets, I mean, look at how many prints there are down below these black circles, right? In prior bears, usually the moves to the downside are considerably longer and the moves to the upside are half as long. But we're much closer to even in this market. It's showing a resilience in the economy. There are investors who are still buying the dip, passive flows coming in from people's 401ks and retirement accounts. Those are also playing a role. So while the drawdown lines up with many other bear markets, the length of these moves is more positive. We're not seeing these uneven downside tilts that we would still see in prior bears, even at just a 10 to 20 or 20 to 30% drawdown. We haven't even gotten over here into the 30% or worse drawdowns yet. So these black circles are only right here. And again, this chart is not that intuitive to look at. This was really me playing around with the numbers and trying to understand how this market works. And what I'm seeing is that the moves to the upside and to the downside have still maintained a relative balance. And that lines up with the fact that the drawdown hasn't been that severe, and we haven't been seeing significant oversold conditions that you would expect to see at the actual bottom of the market. The same way we haven't seen the VIX blow out above 40. If we believe a recession is coming, there are still more downside moves that have not manifested yet in this bear that we could expect to see in a typical bear market. And just to put a really fine point on it, these are official NBER recessions going back to the early 1950s. So actually further back than the bear market study we were doing before. Now, an NBER recession is called by the National Bureau of Economic Research. They officially tag when recessions start and end in this country. They've had the same rules for a really long time. They've been doing it for a long time. And the interesting thing is that every single time they have called a recession and said this is when it began, the bottom of the market came afterward, not before. We are currently not in an official recession. The NBER hasn't called one. Unemployment remains at historical lows. Many other areas of the economy remain stout and strong. We just saw a record in holiday sales. We're still seeing wage growth. People are still holding on to their employment. So generally speaking, we're not in a recession, even though there are a lot of signals of one all over the place. And if we have a base case that a recession is coming in the future, and we look at all prior official recessions going back 70 years, and when we see that the bottom of the market is at minimum a few weeks after the start of an official recession, it's almost impossible to call bottom here. There's virtually no historical precedent for this being the bottom, particularly if we assume that a recession is likely ahead. And we do have that assumption. That is a strong belief. Most of the market is expecting one. I expect one. Yield curves across the spectrum are inverted, telling us that a recession is on the menu. And the fractal of the stock market for every official recession shows a bottom after the date of the recession beginning. So I hope I'm painting a cohesive picture for you here. There is a lot of factual evidence suggesting to us that the bottom of the market is not here yet, that is some months away. And then once it officially begins a recession, afterward is when we can expect to see the bottom of the market. At that time, we could probably expect to see a much higher value on the VIX and to see more oversold conditions in the stock market, particularly on a 3-day chart, which we have not seen even print below 31, 32 on the major indices. A lot of this has to do with the zero COVID policy going on in China. There are a lot of protests and there's civil unrest right now because people are tired of being locked down. They're tired of totalitarianism. But China is still seeing a rise in COVID cases. They're setting a new high for this year. And in Beijing, where the Communist Party sits and where they make all their decisions, local cases are exploding. Now they've pulled back just a little bit here on this latest print. It looks like they came down slightly from the high. But this is utterly dwarfing the prior numbers for Beijing. I am not an expert on China. I'm not trying to provide a hot take or any kind of alpha on it. Just as a casual observer on the other side of the world, we have seen really harsh reactions out of the Chinese government anytime the people try to push back on COVID lockdowns. The Chinese government is completely absorbed in maintaining the illusion of control and in maintaining their chosen narratives. And one of their narratives is that they want zero COVID. So I don't know how this is going to play out. This is part of the reason the market's been selling off and that we've been seeing that safe haven bid in treasuries. And this is what will probably keep the market's attention over the next couple of days. This is a relatively busy week for economic news. There are a lot of indicators that are dropping this week. We've got the typical employment stuff and crude oil stuff that you see, but we've also got consumer confidence numbers, Case-Shiller home price indexes. Jerome Powell is speaking on Wednesday around lunchtime. We also get manufacturing PMIs on Thursday. So there's a lot going on this week. We'll certainly have plenty to talk about in the next video. But what I really want to leave you guys with today are the takeaways from what we're looking at with the stock market. We haven't yet seen total oversold conditions that are indicative of the bottom of a bear market. It hasn't happened for the Dow Jones or the S&P 500. We've barely seen the VIX move whatsoever, and on higher time frames, it's touched values more oversold than it has seen in a decade. We also recognize that every time an official recession begins, the bottom of the stock market is after that date. The shortest time frame was COVID. It was 16 days after the official start of a recession, and that was one of the most violent sell-offs and V-bounce recoveries we've ever seen. So probably not the base case to model future expectations on. Most of these bottoms came many months later. Make sure you follow me on Twitter right here at TXMC Trades. I am supremely active, and this is where you will find me on most days. While you're at it, make sure you check out my newsletter at alphabetasoup.io. There's a link on my Twitter bio and in the description to this video. That's a place for me to share my longer form ideas, share my charts with you, and explore concepts that aren't as easy to put into a video. And that's where we'll leave things today. The main takeaways I wanted to give you guys are that we have not seen the kind of signal that implies to us that the bottom of the bear market has been established. We haven't seen RSI hit certain levels. We haven't seen the VIX hit certain levels. And we haven't even started an official recession. And the bottom of the market comes after that date in all instances. So it behooves us to remain patient. I know it's very difficult to do so. We're not out of the woods yet. This saga has quite a bit further to go, and we won't see a light at the end of the tunnel until some of what we talked about today starts to manifest on the charts. The Dow Jones is at a tricky spot with its retracements. And considering the oversoldness of the VIX, we might not have a lot left in this current leg of the rally, but we'll just have to see. A lot of it depends on what China does this week. If you have any questions for me or any comments or feedback about this channel, make sure to leave it in the comments to this video. I read and approve all of them. I will see what you write. And that's where we'll leave it. We'll give the market a few days to breathe. Maybe we'll make another video at the end of this week and kind of wrap things up and see what we missed. So until the next time we speak, take care of yourselves, take care of your loved ones, give your family members a call during the holidays. This is a time of year when people feel really lonely. And with the current state of the news cycle being an endless grim carousel, people could really use a comforting word or just someone reaching out to them. So make sure you do that. We will talk again in a few days. So with that said, I'll let you go. Cheers, everyone.